If you are lending money from your personal funds into a company or a trust, or another entity, and you want to claim a tax deduction for interest,
Yep.
then it needs to be a separate loan that's separately identifiable to your owner-occupied home loan.
Yeah, because if let's go back to the basics on this. If you borrow money to purchase your own home, the money that you have used from the bank is purchasing your home, and therefore no interest deductible, right?
Yeah.
If you were to buy an investment property and you took out a brand new loan for the entire investment property, the purpose of that loan was to purchase that investment, and therefore the interest is deductible. What gets tricky is when people try and use the loan that's against or for their personal, main residence, to
And they
purchase
redraw.
their investments, and they redraw on that loan, or they take out of their offset account, whatever
Even
it happens
worse,
to
the
be.
offset. Yeah,
Correct.
even worse.
That often is not a tax deduction because you haven't borrowed for the purpose of buying an investment. You've just taken money essentially out of your savings account. It's not a new loan. It's not for the purpose of buying that investment property. Now, you can claim your interest on your main residence for your investment as long as the portion that you're claiming for has actually been borrowed for the purpose of buying that investment. So, for instance, let's say you bought a $600,000 home and you had a $500,000 loan. And then in 10 years' time, your house is worth $1 million, and you've only got a $400,000 loan, right?
You could borrow another
Yeah.
400 potentially.
Example number one, you go and you get a separate new loan of $400,000. So you have two loans of $400,000. One of them was to purchase the original house, and the other 400 you have taken and you bought an investment property. That second $400,000, the interest on that is the tax deduction against the income you earn from that investment property. But let's say over that 10 years, you've done really well, and you actually put $400,000 in an offset account. And so you have essentially zero loan, but really you've got a $400,000 loan with $400,000 in an offset account. And then you take the $400,000 from the offset. That's not a tax deduction. You haven't borrowed.
Exactly.
It's just a savings account.
You can't track
that.
Although it is going to cost you more interest now because you've removed the funds from the offset, and you will actually start to be charged interest on your home loan. It's not a tax deductible interest amount because there's no loan. You've just used your savings, basically. So yeah, the smart thing to do here is new separate loan. Very easy to trace that it is for an investment or a deductible or an income producing purpose that you can claim a deduction against, basically. And it's just impossible to unwind that once it's done,
Exactly.
And the interest rates are high at the moment, so it is really disappointing when you can't claim that 20 grand of interest
for sure.
in your personal tax return. It's like such a big difference.
The opposite of this is true as well. Is if you have a loan against an investment and then you redraw on that loan, or you borrow more money against that investment for private purposes, that interest is not deductible because it's the purpose the money was used for, not
exactly
what asset you've secured it against.
This trips up people all the time. So